Question: if you had invested in a Singapore condominium and held it for the past 10 years versus investing the same amount in the S&P 500 index over the same period, which investment would have yielded a higher return? Hello and welcome to Huat, is the matter where we discuss money matters. Today, Mr. Huat is the matter decided to be serious and not share with you any jokes. So we will answer the question shortly. To determine which investment yielded a higher return, let's compare the average performance of Singapore condominiums and the S&P 500 index over the past decade. 1. Investment in Singapore condominium. Initial investment. Let's assume an initial investment of SGD $1 million in a Singapore condominium. Average annual return. Historically, Singapore residential properties have provided an average annual return of about 2.5% to 4.5%. For this calculation, we'll use a conservative average return of 3.5% per year. Future value calculation. Using the formula for compound interest where FV denotes future value, PV denotes present value, which is SGD $1 million. RR denotes rate of return, which is 3.5% or 0.035 in decimal points, and NN denotes the number of years, which is 10. Total return. The investment in the condominium would have grown to approximately SGD 1,410,600 over 10 years. Second, investment in S&P 500 index. Initial investment. Let's assume an initial investment of SGD 1 million in a Singapore condominium. Average annual return. The S&P 500 has delivered an average annual return of around 10% over the past decade, including dividends. Future value calculation. Using the same compound interest formula, where FV is future value, PV is present value, which is SGD 1 million. RR is annual return rate, which is 0.10. NN is number of years, 10. Total return. The investment in the S&P 500 would have grown to approximately SGD 2,593,700 over 10 years. 3. Comparison. Condominium investment. SGD 1 million, grown to approximately SGD 1,410,600. S&P 500 investment. SGD 1 million grown to approximately SGD 2,593,700. When choosing between investing in Singapore properties or US equities, Singapore investors face a complex decision. Both asset classes offer unique benefits and challenges, but their performance over the past decade has varied significantly. This article delves into detailed performance data, average returns, and leverage strategies, drawing insights from different sources. 1. Performance overview. Properties, condominiums. In Singapore for the last 10 years from 2014 to 2024, market trends. From 2014-2018, according to online sources, Singapore's private residential property market saw a downturn due to cooling measures like the additional buyer's stamp duty, ABSD, and loan-to-value, LTV limits. Some data showed a cumulative decline of about 8% in property prices from 2014 to 2017. 2019 to present, the market began to recover post-2018 with a resurgence in 2020 and 2021 as the economy rebounded from the pandemic. Private residential prices rose by 8.4% in 2021 and continued their upward trajectory into 2022 and 2023. Average annual return. Over the past decade, the average annual return for Singapore residential properties has been approximately 2.5% to 4.5% per annum, including rental yields and capital appreciation. The lower end reflects the period of stagnation and cooling measures, while the higher end reflects the recent recovery and growth. U.S. equities last 10 years, 2014-2024. Market trends, 2014-2019. U.S. equities enjoyed a strong bull market, driven by technological advancements, low interest rates, and economic growth. The S&P 500 index, for instance, saw an annualized return of around 13.6% from 2014 to 2019, according to Seedly. 2020 present. Despite the volatility caused by the COVID-19 pandemic, the U.S. stock market rebounded sharply. The Nasdaq and S&P 500 indices recorded gains of approximately 18.4% and 21.7% respectively in 2020. For 2022, while the market faced corrections, long-term growth trends remained strong. Average annual return. Historically, U.S. equities have delivered an average annual return of 8% to 12%. This figure includes capital gains and dividends, but excludes transaction costs and taxes. 2. Let us look into the investment and leverage component and compare. Upfront investment. Typical costs. Purchasing a condominium in Singapore requires a substantial upfront investment. For a property valued at $1 million, a typical down payment is 25%, translating $250,000. Additional costs include stamp duty, around 3% to 4% of the property price, legal fees, and maintenance costs. Leverage, loans. The loan-to-value (LTV) ratio allows financing up to 75% of the property's value for a first property purchase. This enables investors to leverage their investment significantly, potentially amplifying returns. U.S. equities upfront investment. Typical costs. Investing in U.S. equities can start with a relatively small amount, depending on the stock prices and investment strategy. Investors can begin with as little as a few $1,000s, thanks to fractional shares and low-cost brokerage accounts. Credit facilities. Margin trading. Investors can use margin accounts to borrow funds from brokers to purchase additional shares. Typically, brokers require an initial margin of 50% of the total value of the securities. This leverage can enhance returns but also increases risk. Margin trading can magnify both gains and losses, making it a high-risk strategy. 3. Comparative analysis. Risk and return properties. Risk. Real estate investment in Singapore is relatively stable, but not immune to market fluctuations. Cooling measures, economic downturns, and changes in government policies can impact property values. Leveraging through mortgages can amplify risks if property values decline. Return. The returns from property investments are generally stable, with consistent rental yields and moderate capital appreciation. The recent recovery in the property market has improved returns, but with lower volatility compared to equities. U.S. equities. Risk. Equities are subject to higher volatility and market risk. Economic cycles, geopolitical events, and market sentiment can cause significant price swings. Margin trading further amplifies this risk. Return. Historically, U.S. equities offer higher potential returns compared to real estate. The high return is driven by the robust performance of technology and growth stocks over the past decade. Liquidity. Properties. Real estate is a less liquid asset. Selling a property can take several months and involves significant transaction costs. Maintaining and managing the property also requires ongoing effort. U.S. equities. Stocks are highly liquid, with the ability to buy and sell shares quickly and at low transaction costs. This liquidity allows for greater flexibility in adjusting investment positions. 4. Conclusion. Investing in Singapore properties and U.S. equities each presents unique advantages and challenges. Over the past decade, U.S. equities have outperformed Singapore properties in terms of average annual returns, driven by technological advancements and a strong bull market. However, real estate investments offer stability and the potential for leveraging through mortgages. For Singapore investors, a balanced approach may involve diversifying across both asset classes to leverage their strengths. Properties offer stability and income generation, while equities provide growth potential and liquidity. Understanding the associated risks and leveraging strategies is crucial for making informed investment decisions. Mr. Huat is the Matter aims to provide more entertainment videos like these. I really need your support as it is a motivator for me to carry on. If you would like to support to Huat Big, please subscribe and like the video as it will really help me. Mr. Huat is the Matter loves you, my dearest subscribers.